A successful Millennium portfolio manager joined my hedge fund learning platform, and I'll share some lessons I learned from him. His name is Alan White, and he spent 10 years as a portfolio manager at Millennium, one of the best and largest hedge funds in the world. 10 years. The average yearly portfolio manager turnover rate at Millennium is 30 to 40%. This is an insane longevity and a testament to how incredible of an investor he is. Prior to Millennium, he worked for 8 years as a portfolio manager at Carlson Capital, where he began his career. Alan is now the CIO of Orchid Capital. He's one of the finest investors I've spoken to, and I'm excited to share some lessons from him. Alan has a truly market-neutral investment process, which I'll explain what it means and give an example. Alan is comfortable betting against short-term momentum, and when a position goes against him, he tends to use it as an opportunity to build up the position. So if he makes a trade and he's losing money, he tends to increase his position rather than get out of it. In 2019-2020 period, he did a pair trade, long Domino's, short Yum Brands. The following chart shows how the pair trade performed. It shows the ratio of the two share prices over time. Domino share price over Yum Brands share price. As you can see, it proceeded to go against him by almost 10% over the following month, which allowed him to build the position. It was back to flat in another week, up 30% overall in 4 months, up 70% from inception just before COVID hit, and then went up a parabolic 250% by the end of March 2020. Alan only captured a fraction of that return as he was out of the position before COVID hit. But it does highlight a lot of lessons. The inflection point for Domino's actually came on a day that they missed estimates and lowered their 2 to 3 year outlook. Stock was down 6% pre-market and finished up 5% on that day. Alan does a full deep dive and discusses all aspects of this trade on the platform. Alan has a winning market-neutral investment process. He's always trying to hedge out all possible factors, only isolating that one thing or a set of things that he has a differentiated view on and is betting on. What does that even mean? Let's say that you have a strong fundamental view that Nvidia will outperform AMD. Let's say because of pricing power in AI chips, better supply chain positioning, and stronger enterprise adoption. That's your thesis. So you want to put on a trade long Nvidia, short AMD. If you only go long Nvidia, the problem is you're exposing yourself to unwanted factors or exposures. Your P&L will be influenced by factors you don't intend to bet on. For example, the size, growth, and momentum factors. Nvidia is a classic large cap, high growth, high momentum stock. If momentum as a factor starts reversing because of, for example, rotation into value stocks, Nvidia can still go down even if it's fundamentally strong. You'll also be exposed to the semiconductor sector factor. Nvidia is a semiconductor stock, and if the entire semiconductor industry sells off due to a demand slowdown, regulation, or supply chain issues, Nvidia will likely drop along with all other semiconductor stocks like AMD, Intel, and others, regardless of your specific thesis on Nvidia. You're also exposed to the technology factor. If the Nasdaq tanks, Nvidia is likely to go down too. So instead of just going long Nvidia, you also want to pair it with a short that has similar characteristics and factors so that you can hedge against those. You also want to put short AMD. So now you're hedged against some of these factors. You only want to be exposed to that one single thing you're betting on. The goal is to win regardless of whether the market goes up or down. Alan has his investment process battle tested to the T. From screening for ideas to constructing a variant view to knowing exactly what makes a trade worth putting on. For example, here's a small snippet of Alan's investment process checklist, a framework built for repeatable success. Do others agree with us? Where do we differ? Are others in the trade? What are the unhedged risk factors? What is the worst case scenario? This is on top of him looking at valuation, quantifying sentiment, setting targets. He teaches all of this on Phoenix. How to have a differentiated and meaningful view, how to gain conviction, how to measure risk and reward for a trade. And even better, Alan's investment process is generally on a 6 to 12 month horizon, which makes it suitable across investment styles and hedge fund types. My personal favorite part is getting a glimpse into how a world-class investor fundamentally thinks about stocks and trades. There's a lot of noise online, all the same fluff and commoditized information. No one really shows you real examples of positions they put on, or what it really means in practice to generate alpha on one of these multi-manager hedge funds. Whether you're already at a hedge fund, looking to break in, or simply trying to learn, this is for you. Check it out.